Hi, this is James Shug with Westpac London's end-of-day report for Wednesday, February the 13th. Look, European markets, stock markets, did okay today actually. We had some earnings reports that beat expectations. Peugeot, Citroën, Heineken, to name a couple. European industrial production, or Euroland industrial production, rose 0.7% in December. Now that reversed November's fall, and there were two monthly falls prior to that. So it's still a weak outcome, but it kind of signals that maybe at the end of 2012, the slump in economic activity was already stabilising. Certainly that's the view that investors seem to have taken from that data. For those interested, Germany was up 0.8%, Italy up 0.4%, but France and Spain are both flat in the month of December. And the annual pace of decline in industrial production in the Eurozone is 2.4%. The Bank of England inflation report didn't really have any surprises, given that the press statement released after last week's Monetary Policy Committee decision had pretty much revealed the guts of it, and that was that CPI inflation is expected to remain above the 2% target for the next 2 years, and in fact doesn't fall back to the target until well into the third year, so that takes you out to late 2015, early 2016. They've basically lifted their average CPI central projection from 1.8% over the next 2 years to 2.4%. That's compared to their November projections. Now, higher inflation is due to university fees, sterling depreciation, higher energy prices, and the Bank of England basically assesses that they are persistent, but nevertheless one-off factors that don't reflect underlying economic conditions, and they're going to look through that when setting policy. And the governor said that further asset purchases were still possible. Were inflation expectations to rise, they would act to perhaps tighten policy, but given that they've actually downgraded their growth view, they are looking for a very modest recovery to come through in economic activity, but with downside risks. Given that slower growth outlook, the bias still does seem to be towards one of maintaining the current very low or very easy policy stance. The assumptions that the forecasts were predicated on include no tightening in policy, no sale of assets that are purchased, or no interest rate rise for almost 3 years. So a long period of steady policy is the assumption there, and that was based on market pricing. In the US, retail sales rose 0.1% in January. Core retail sales, excluding gasoline and autos, were up 0.2%, down from sort of 0.8%, 0.7% outcomes in November and December. Now, you've got to regard that as sort of like consolidating rather than a weak report. We had a spurt in sales at the end of last year, and a modest further gain in January. Remember, personal income rose very sharply in December because of the pull forward of bonuses and dividends payments by firms to avoid the tax hikes that were anticipated in early 2013. And so that income boost may still be supporting spending, but we're going to see income reverse early in 2013, and so it's going to be difficult for sales to continue to post decent rises. We're looking for some constraint on spending from the income side of things in 2013. So they're the main economic data releases. Of course, we had Obama's State of the Union address last night. He talked about a range of things, but markets kind of been weighing what he said. Increasing the minimum wage, for example, is on his agenda. So we saw the likes of McDonald's share price fall as a result of that. One other driving factor in the US was the NBC sale by GEC, by the General Electric, to the cable company. I forget the name of them, and that saw both firms' share prices push higher, but the US markets struggled to maintain early gains. So let's give you some numbers. At the close, the FTSE in London up 1/3%. It's a 4.5-year high actually. The gains were stronger early in the day, but the unwinding of US markets sort of constrained the closing prices there for the FTSE and the other European markets. The French market also up 1/3%. The Germans up 2/3%. Spain's up 0.9%, and Italy up 0.4%. The Dow at the moment is down 1/3%. It's 5:30 in London. The S&P 500 is actually unchanged, and the Nasdaq up 0.1%. So they're the markets in stock markets. In terms of commodity markets, gold price is down 1/4% at $1,645 an ounce. Copper's down 0.2%, and we've got oil unchanged at $97.52 a barrel. The Aussie dollar, it's at 1.035 against the US dollar. It jumped, well, pretty much a cent or more, mostly related to the Westpac Melbourne Consumer Sentiment release. We saw an near 8% rise in sentiment in February, and that's been a decent supporter of the Aussie dollar. That's about it for today. We've got European GDP in the fourth quarter figures to watch for tomorrow, Thursday, and I'll be around to report on that.